I don't think whole life policies are designed to build money up and then take money out permanently, because there's typically a net cost to borrow, okay? And if you don't pay that loan back, then there's a cost associated with those outstanding loans that can really take a toll as it compounds over time. I think that whole life can accomplish a lot of the same things that I'm hoping to accomplish with IUL. After all, Ernst & Young, the product that Ernst & Young used, if you look at the Ernst & Young study, it literally says right there in the footnote, whole life was used as a volatility buffer type strategy, right? So in the down years, they borrowed from the whole life, and then when the stock market came back up, then they paid that loan back, right? So what I'm doing is I'm looking at the IUL as slightly to the right of whole life on the risk continuum. And I think that you only do IUL if you think that risk premium can get you a slightly higher rate of return over time. And this is where I think that slightly higher rate of return could be useful. If the goal is to accumulate 3 to 5 years worth of living expenses in your cash value of your IUL by day one of retirement, and let's face it, that's your deadline. You gotta have it all there by day one of retirement, because you never know if the first year of your retirement is going to be down or what have you. So the question is, whatever money that could have otherwise been directed to the stock market is going into my cash value life insurance. And the goal is to get 3 to 5 years worth of living expenses in that cash value life insurance. Which one will enable me to do it less expensively? Okay. Now, remember, I'm recognizing that IUL has risks, but I think that in exchange for those risks, I am getting, like I said, that slightly higher rate of return. So if the goal is 3 to 5 years worth of living expenses, and I put that money into an IUL policy versus a whole life policy, the bet that I'm making is that it will take less money to accumulate the 3 to 5 years worth of living expenses, which means that I'm not having to take as much money out of my stock market portfolio or redirect as much money to my IUL away from my stock market portfolio along the way. Because if I have to the more money I have to put into these insurance contracts, the greater the opportunity cost I'm going to have to experience along the way. So the question is, which one allows me, in theory, to invest the least amount of money to accomplish that end objective? Okay, so that's the first point that I would make, is that if you think that the IUL can reliably give you that 1 to 1.5 points more over time, then in theory you would invest less along the way to be able to accumulate the right amount by day one of retirement. The second consideration that I would put forth is that I don't believe whole life policies, and Tom, you're the PhD on this, so feel free to sort of put me in my place. I don't think whole life policies are designed to build money up and then take money out permanently. Okay? Why? Because there's typically a net cost to borrow, okay? And if you don't pay that loan back, then there's a cost associated with those outstanding loans that can really take a toll as it compounds over time. One of the reasons why I like the IUL is because I can find a carrier that gives me a guaranteed 0% loan, okay? So when it comes time to take that loan out of the IUL to pay for my living expenses in retirement, I don't necessarily have to pay it back, okay? If I had to pay it back, how would I pay it back? I would pay it back with money that was otherwise in my stock portfolio earning whatever you want to say, 8, 9, 10%, 12% if you're Dave Ramsey. So if I have to pay that loan back, I'm taking money that could have otherwise accumulated in my stock market and pay that loan back. There will be an opportunity cost associated with paying that loan back. That money is no longer growing in my stock market portfolio because I had to pay my loan back. And so those are the two considerations that I work through. And Tom, I'm sure you've thought this through and have a very good answer for it. But those are the two considerations. I'm getting a slightly higher rate of return. Therefore, I have to put less money into the contract to accumulate the requisite amount I need by day one of retirement. And because I can take that tax-free, cost-free loan out and I don't have any net interest that I'm paying, I'm not constrained to pay that back with money that could otherwise be growing in the stock market. And that the net effect of all of those is to build my wealth higher over time.
Yeah, and
if you believe that you can continue to get a reasonable rate of return in the stock market.
Yeah, and I will just say those two things are a big deal, though. It's really, one addresses the accumulation, and the other addresses a more efficient distribution, essentially. And so, but would you say those two are the main, and then everything else, that whole life also checks the box, the permanent death benefit, the long-term care-esque return, like all those things are relevant because it's an insurance contract. But the reason you like IUL are potentially a more efficient accumulation and a more efficient distribution.
Yeah, people come to me and say, Dave, the guy that wrote the foreword for your book, The Guru Gap, Wade Pfau, prefers whole life. I say, great. Whole life could totally work in this situation. I'm just saying that if the goal is to build 3 to 5 years worth of living expenses, it's going to take more money to pull that off. And money's not going to grow quite as quickly if you believe that the IUL, given that risk premium, is going to sort of push you further ahead.
Yeah.
And then if you look at the Ernst & Young study, the Ernst & Young study says that the loans were paid back, and they're paid back out of the stock market portfolio. So those are my considerations. And I'm not in any way demonizing the whole life approach, because for crying out loud, Ernst & Young, that's the product that they use. And so you can't really vilify it. I think I heard you say on a video once, Tom, that the reason you believe the way that you do is because you were weaned in a whole life company, in a whole life environment where they really inculcated this idea that you have to protect, you have to build a foundation of protection. That's sort of what you do right out of the chute. You've got to build a foundation of protection. That doesn't ever really enter into the picture for me. To me, I've got very stated objectives. Okay. The stated objective is you build up net worth as effectively as you can. You save as well as you can over time. You invest mostly in stocks during your accumulation period. I do think there would be opportunity cost if you started early off in life with whole life, and you're incorporating that bond-like alternative into the mix too early on in life. I do think there would be an erosion in your net worth over time, because you're taking money that could have otherwise harnessed the power of the stock market, and you're putting it very early on into a bond-like return. So I think that's a consideration. But really, at the end of the day, I am not using the IUL as a way to protect my assets. It doesn't even enter the picture. I am looking at it as a tool. It's slightly to the right of whole life on the risk continuum. And when I say I believe you can, if you believe you can get, I'm being slightly deferential here, because we're both nice people and we're having a nice conversation. But I'm basing that on the idea that over the last 20 years, an IUL through a good carrier has gotten those types of rates of return. And I believe, and I've talked to actuaries who have done Monte Carlo scenarios on these things using caps of about 10% over time. And they say that 99.5% of the time, these policies stay in force when funded properly, right? When maximum funded and executed in the way they were intended to be executed, okay? So is there risk associated with down returns? Certainly, but you're getting something in exchange for that risk. You're getting a slightly higher rate of return, and I think that history bears that out. And over the last 20 years, we've had high interest rates, we've had low interest rates, we've had surging interest rates, we've had so I think we've seen all sorts of different types of environments, and I think that an IUL through a good carrier that has integrity when it comes to cap rates has performed in the way it was intended to perform, which is to say a point to a point and a half higher than what you could have otherwise gotten had you put that money into whole life. And I think that given the choice between having a guaranteed 0% loan and a loan provision where it could fluctuate based on whatever interest rates happen to be, or whatever the portfolio rate happens to be, where you could be paying 2 or 3% net percentage. If you look at the charts that show the net toll that takes on your cash value, because remember, that interest has to be accounted for somehow. You either have to pay it back, and how are you going to pay it back? Out of your stock market portfolio. You can use paid up additions or what have you to pay it back. I'm not using the right jargon here, I know, but the point is, there's no free lunch. That interest has to be paid somehow. And given a scenario where I can choose between having a scenario where the interest rate could ebb and flow over time, and having a guaranteed 0% interest rate that's guaranteed in the contract, I would take the guaranteed 0% every single time. So in summary, again, I'm looking at something where I think, based on historical rates of return, that I can get 1 to 1.5% higher, and to get that guaranteed 0% loan, so that I'm not required to pay that money back out of my stock market portfolio down the road.
I think your dogs are agreeing with you, David. I just wanted to double click on one thing you said. You don't use life insurance as like a asset. I don't want to put words in your mouth. You asset protection, or maybe like you maybe don't necessarily buy into like the backstop conversation. You said something like that, because I think that was the epiphany for me around like why you believe this. But then I can also understand if someone did see it as like a backstop, that was like a big part of their thesis, where they would say, yeah, I would rather have the guarantees because it's that important. You said it, and then I just wanted you to maybe repeat or flesh what you meant by that.
So the backstop, in my mind, would not be a whole life policy. It would be a guaranteed lifetime income annuity coupled with Social Security, possibly a company pension. So the backstop is, I want to guarantee 100% of my living expenses and adjust those for inflation over time. And then I can use the insurance policy, the IUL, to accomplish some specific objectives in retirement. Primarily the long-term care, but in some cases the volatility buffer.
Understood. And so you're essentially saying, which makes sense, if you're like, if this is not the foundation or the backstop, then why would I, if that's less important to me, if I already have that backstop with maybe different annuities and Social Security and planning, then why wouldn't I try to get a higher outcome? Because that's where I'm going. But you could also see where it's like, if someone had that as the backstop or the foundation, and that was it, where it may bring a lot more peace of mind when it comes to planning, to say, hey, I would be willing to take less upside potential over time, but to have that quote unquote peace of mind. And I know that there will be other people in time you can mention that. I know the goal is, the reason why people do IUL is for that upside potential and maybe more efficient distribution. But I know that there's people that just say like, well, over a long period of time, that's going to be the exact opposite. I don't know if we even need to get into that now, but I think no one would do IUL if there wasn't that. You wouldn't take less guarantees and then get less, like you wouldn't take less guarantees for a smaller outcome in growth wise and a smaller outcome in distribution. I think that's a pretty fair statement. If we live in a market that wants to stay competitive, the IUL carriers have to try to give some type of reason why you would maybe part ways with more guarantees for that upside.
Let me just real quick, and Tom, you can weigh in on this. I've done comparisons where you take an IUL, you maximum fund it, and you just put the money in the fixed account. And then you run that out and compare it against a whole life policy where you're maximum funding it, and then you take loans out of both policies out the back end. So you're not even messing around with the index caps. You're not messing around with the fact that you could get 2 or 3 down years in a row. You're just going with the fixed account. And I know fixed accounts, you don't get the same thing every year, but it's based on interest rates. But interest rates affect whole life policies like they affect IULs as well. But because of that 0% loan, that IUL policy is going to distribute money more efficiently over time than the whole life policy is, because you have to reckon for that net cost of borrowing that exists. That's a reality that you have to confront in the whole life policy. And so if you're just looking at pure building money up, even if you forget the index part of it, you just go the fixed account. You say, I don't want to mess with the index. There's too much risk associated with that. I'm just going to put money into the fixed account and do that each and every year. Couple that with the guaranteed 0% loan that I can distribute down the road. I think that's a pretty efficient way to go. It's not going to build the money quite as quickly, I don't believe. But I think that when given the choice of that approach versus the whole life approach, I think I'd still take the IUL.